This Friday, June 12th, 2026, the biggest company in the world to ever go public is hitting the Nasdaq, SpaceX. $1.77 trillion, raising about $75 billion in a single day, instantly the seventh most valuable company in America, bigger than Tesla. And you as the part nobody told you, you might already be buying it. Even if you would never touch a money-losing rocket company at that price, your 401k might be forced to buy it for you because a couple of index providers quietly rewrote their rulebooks just weeks before this IPO. So today I want to walk you through exactly how that happens, who actually wins, and the calm little playbook that puts you back in the driver's seat. Quick reminder, we do this every single day, breaking down the money story that actually touches your wallet. So hit subscribe and stick with me because this one is wild. Let me start with a simple version, because once you see it, you cannot unsee it. When you put money into a 401k or an index fund, you probably are not picking individual stocks, you are buying a basket. That basket tracks an index, like the S&P 500 or the Nasdaq 100 or a total market fund. And an index is really just a list with rules. A company gets added to the list when it meets the rules, and your fund automatically buys it. Do not click anything, you do not approve anything, the fund just quietly follows the list. Think of your index fund like a grocery delivery service on autopilot. You signed up once, you said just buy me the standard basket every month, and you stopped thinking about it. But you never actually see who decides what goes in the basket. Somewhere there is a person with a clipboard writing the shopping list, and your card gets charged for whatever they put on it. Most of the time that is totally fine because the list is sensible. But if that person quietly adds a brand new item right before it gets expensive, you are paying for it before you even knew it existed. So the real question here is not whether SpaceX is a good stock. The real question is who writes the list and what happens when they change the rules right before the most hyped IPO in history. Here is what makes this company so interesting and so confusing. Back in February of 2026, Elon Musk merged SpaceX with his AI company, xAI. So the thing going public on Friday is not just a rocket maker anymore. It is a satellite internet and artificial intelligence conglomerate wearing a rocket company's name. And when you actually open the prospectus, the document they are legally required to file, the numbers tell a split story. In 2025, revenue was $18.7 billion, up 43% from the year before. That is real growth. But the company also lost about $4.9 billion on paper that year. Not trillion, billion, I want to be precise. And almost all of that loss came from the AI side, which burned about $6.4 billion by itself. Now here is the twist most headlines skip right over. The rocket and satellite part of this business is actually doing great. Starlink, the satellite internet service, pulled in $11.4 billion, which is 61% of all revenue, and it made $4.4 billion in operating profit. Strip out the AI division, and SpaceX would have netted about $791 million in profit last year. So you are looking at a profitable space company strapped to a cash-incinerating AI bet. And the market is being asked to value the whole bundle at $1.77 trillion. To put that number in perspective, that is a company about to be worth more than Tesla, valued like a flawless winner, while its own books show it is bleeding red ink from the AI side. The company's own prospectus even warns, in plain language, that it has a history of net losses and may not achieve profitability in the future. When a company is legally telling you that about itself in its own paperwork, that is not a footnote to skim past. That is the company being honest, and it is worth listening. So that is the company. Now let's get to the part that actually affects your retirement account, because this is where it gets really good. To get into an S&P 500 fund, a company has to clear 4 bars. It needs a market value of at least about $22.7 billion, which SpaceX clears easily. It needs positive accounting profit, which it does not have. It needs at least 10% of its shares trading publicly, which it does not have. And it needs to have been public for at least 12 months, which obviously has not. So SpaceX fails 3 of the 4 tests. And on June 4th, 2026, the people who run the S&P indexes did something kind of refreshing. They refused to bend the rules. No exceptions. So SpaceX is not going into your S&P 500 fund. The earliest it could even qualify is the middle of 2027, and only after 4 straight quarters of real profit. Hold on to that, because it tells you something about who blinked and who did not. Because Nasdaq made a different choice. On May 1st, 2026, just weeks before the IPO, Nasdaq rolled out a brand new rule. They call it fast entry. Under the old rules, a company had to wait roughly 3 months after going public before it could join the Nasdaq 100. The new rule cuts that down to 15 trading days for any company that ranks in the top 40 by market value. And they also threw out the minimum float requirement entirely. SpaceX, at $1.77 trillion, sails into the top 40 without breaking a sweat. So a company that is barely 2 weeks old as a public stock, that lost almost $5 billion last year, gets a fast pass into one of the most popular indexes on the planet. And FTSE Russell, which runs the total market indexes behind funds like VTI, adjusted too, so those funds scooped up even faster, in about 5 trading days. If you are finding this useful, this is exactly the kind of thing we dig into every single day on this channel, so take 1 second and hit subscribe. Now here is why the timing of those rule changes matters so much, and it comes down to one sneaky little detail called float. Float is just the slice of a company's shares that are actually available for the public to trade, and SpaceX is floating only about 3 to 4% of itself, almost nothing. Compare that to the giants you already own. Microsoft floats 99.97% of its shares. Nvidia floats 95.8%. Amazon floats 90.5%. Those are normal, healthy companies where almost every share is out in the open. SpaceX is keeping roughly 96% of itself locked up, with Elon Musk holding over 82% of the voting control, a stake worth around $841 billion. So at the start, even though the valuation is gigantic, the index funds only have to buy that tiny floating slice. SpaceX shows up as a small sliver of your fund, easy to ignore. And that is exactly what makes it a time bomb. Here is the mechanism, and once you get this, you understand the whole game. Index funds weight companies by their float, by the shares actually available. So when only 3% is floating, SpaceX is a small position. But early insiders and employees are locked up only temporarily. That lockup is just a promise not to sell for a set window after the IPO, usually a few months. The day it lifts, all those shares that were frozen suddenly become tradable. As those lockups expire over the coming months, those insiders start selling. The float grows. And as the float grows, the index rules force your fund to buy more and more SpaceX to keep up. Think about what that means. The insiders who got in early at low prices are selling, and the buyer on the other side of that trade, automatically, mechanically, is your retirement fund. The everyday investor becomes the exit door for the early money. That is not a conspiracy. That is just how float-adjusted indexing works when you combine it with a fresh IPO and a freshly rewritten rulebook. The order matters too. The rules got loosened first, on May 1st. Then the IPO comes June 12th. Loosen the gate, then drive the truck through. That sequence is the whole story. And there is one more layer because Nasdaq tweaked something else too. Normally, a low-float company would get a tiny weight in the index, but the new rules let a low-float company, with a float up to about 33%, be weighted up to 3 times its actual float inside the Nasdaq 100. So SpaceX gets punched up to a bigger slice of your fund than its real trading shares would justify. Add it all up, the Nasdaq 100 funds and the Russell funds together, and analysts estimate $22 to $27 billion of automatic forced buying. Money flowing into SpaceX, not because anyone decided it was a good investment, but because the rules say the funds have to. Here is the part that really got my attention. Those funds do not have a pile of spare cash sitting around. They are basically always fully invested, every dollar already working. So to buy all that SpaceX, they have to sell something they already own to make room. What do they trim? The stuff already in your portfolio: Amazon, Microsoft, Nvidia. The companies that actually earn money, that pay their way, that you would happily own on purpose. A little bit of each gets quietly clipped to fund the new arrival. So this IPO is not just a buying event for one new stock. It is also a quiet selling event happening inside your own fund, shaving a sliver off the great businesses you actually wanted to own, to make space for a newcomer that lost almost $5 billion last year. Picture it like your own grocery basket again. The autopilot just swapped a little of your steak and your vegetables for a shiny new product nobody has tasted yet, and it charged you for the swap. You did not vote on that. The rulebook did it for you. Now, before you panic and do something dramatic, let's pump the brakes and bring in some history, because IPOs are genuinely a mixed bag, and I want you to see both sides. From 1980 to 2020, the average IPO jumped about 18.4% on its very first trading day. Sounds amazing, right? But here is the catch. That pop mostly goes to insiders and the well-connected buyers who get shares at the IPO price. The IPO price is the price insiders sell at. By the time a regular person can buy on the open market, the stock is often already up that 18%. You are buying the excitement after the people in the know have already cashed in. And long-term, the picture gets humbling. A Nasdaq study found that about 64% of IPOs underperformed the market by more than 10% 3 years out. Read that again. 3 years out, most of them lagged the boring old market average. So the typical IPO is not a rocket, it is a slow leak, and the few that soar get all the attention while the quiet majority get forgotten. But, and this matters, the exceptions are legendary and they are the reason people keep betting. Amazon went public in 1997 at $18 a share, lost money for years, crashed about 95% in the dot-com bust, and today it is one of the most valuable companies on earth. Anyone who held through that pain made a fortune, and almost nobody actually held. Tesla went public in 2010, was unprofitable for a full decade, and turned into a giant. Uber went public in 2019 and bled billions for years before finding its footing. And then there is Pets.com, the poster child of the dot-com frenzy, which IPO'd to huge hype and went bankrupt within about a year, taking its investors down with it. Same setup, same excitement on day one, wildly different endings. Some bulls think SpaceX could rocket toward a $5 trillion valuation on day one. Morningstar, on the other hand, argues the company is worth less than half of that $1.75 trillion target. Nobody actually knows. An early IPO is a gamble, full stop, and anyone who tells you otherwise is selling something. So let's bring it home, because here is the genuinely empowering part. A stock's price, on any given day, is just supply and demand. Right now, you've forced index buyers propping the price up, which can make it look unstoppable for a while. But you also have insiders, sitting on shares they bought cheap, who can start selling once their lockups expire. When that selling pressure shows up, it can push the other way. Knowing that both forces exist is what keeps you calm while everyone else is reacting to headlines. And by the way, this is education, not financial advice. I am not telling you to buy or sell anything. I am showing you how the machine works so you can make your own call. So here is your simple playbook. 4 moves, and you can do all of them this week. Move 1. Know what you actually own. Pull up your 401k and look at your funds. Is your money tracking the Nasdaq 100 like a QQQ fund? Then yes, SpaceX is coming your way fast. Is it a total market fund like VTI? Same deal, even quicker. Is it an S&P 500 fund? Then for now you are not getting SpaceX at all, because the S&P held the line. Just knowing which bucket you are in tells you almost everything. Move 2, do not make a giant retirement decision over one small holding. Even after all the forced buying, SpaceX is going to be a tiny slice of a broad fund, and your retirement strategy should not get blown up by a single stock you did not even pick. Panic selling your whole 401k over this would be the real mistake. Move 3. If you genuinely want SpaceX exposure, then choose it on purpose. Decide how much, size it deliberately, and own that decision. There is a world of difference between choosing a bet and having a bet quietly assigned to you by a rulebook you never read. Move 4, the one that actually changes how you invest forever. We all love to say passive investing is hands-off, just set it and forget it. But this whole story proves it is not fully passive. Somewhere, a small committee at an index provider can rewrite the rules weeks before an IPO and reroute billions of your dollars into a company you might never choose yourself. That is not a reason to fear investing. It is a reason to understand it. Because the moment you know how the list gets written, who writes it, and what happens when they change it, you stop being a passenger. You become someone who actually understands the machine their money lives inside. And that understanding, honestly, is the real edge. Way more valuable than any single hot IPO. So when Friday comes and the headlines are screaming about the biggest IPO in history, you are going to be the calm one in the room. You will know it is not magic, it is supply and demand. You will know the float trick and why your fund's tiny SpaceX slice can quietly grow. You will know that the S&P said no while the Nasdaq said yes. And you will know exactly what is sitting inside your own 401k because you checked. That is what turns a scary headline into a shrug. If this helped the whole IPO machine finally click for you, do me one favor and hit subscribe, because we break down a money story exactly like this every single day, always in plain English, always pointed straight at your wallet. Go check what your 401k actually owns this week. Stay curious, stay calm, and I will see you in the next one.